Okay, hi everyone. This is Rob Barnett from Bloomberg Intelligence, and I want to welcome you to our bi-monthly research call where we talk about some of our research and the latest developments in the market. Today we are honored to have a special guest, Rory Johnston from Commodity Context, to come join us and help us unpack what has been a very eventful few weeks. Just looking at the screen right now, crude oil is flirting with about $100 a barrel at the moment. European natural gas prices just over 100 euros a megawatt hour still. So we've seen some pullback here recently, but prices are still very elevated if you look at them over the course of the last 12 months or so. I would just highlight that we have a very comprehensive report out this morning by Will Hares, Patricio Alvarez, and a number of the other folks on the team looking at commodities broadly in a scenario framework. And so, three simple ideas. The one is that we see an easing of the Russia-Ukraine conflict. Another idea is that we see kind of a continuation of the status quo, or that we potentially see an escalation, and we try to put some boundaries on what some of the main commodities could do under that sort of basic lens. So, Rory, since you're the guest, I want to come to you first. How do you read the supply-demand balance for oil at the moment, and what's your worst case scenario look like if you see an escalation in Russia-Ukraine that gets worse from where we are today?
Yeah, well, thanks, Robin. Thanks for having me on the call. Really, really happy to be here. I've always been a huge fan of the Bloomberg Intelligence team's research, and I myself am a Bloomberg terminal user, so very, very happy to be here. On the question of crude oil, and obviously this has kind of really taken up a lot of my kind of mental space over particularly the last couple of weeks. I tend to think about it, we come into the Russia-Ukraine crisis with, already, Brent just around the 90s, already the highest point since 2014. We're kind of, back down to very low, or at least, reasonably low inventories on a global level, back to that kind of 2010 to 2014 level, and probably sitting at somewhere in the ballpark of 1.5 million barrels a day of kind of spot deficit in the market. So we were already pretty tight, enough of tightness that, you could easily have been very bullish absent anything that's happened in the last month. Then you have, obviously, the third largest oil producer in the world invade its neighbor, and the world kind of, take a step back and say, whoa. You start with a bunch of red lines that we're not going to touch energy exports. There's explicit carve-outs on sanctions, etc. But very quickly what you see is that the biggest impact of this by far is going to be this self-sanctioning behavior of particularly Western firms that just don't want to deal with the headache or the potential PR or legal nightmares associated with taking Russian crude. The cautionary tale here was when Shell purchased their shipment of crude. I think in their statement very reasonably came out and said, look, this is what Western governments wanted. They didn't want an energy shock. So we're taking this crude. And obviously, they thought they were in the right. And I think by the letter, they probably were. Within a couple of days, it didn't matter. The PR blowback was immense. They were more or less raked over the coals and kind of had to come out a couple of days later and say, look, we're sorry. We made an error in judgment. So I think that's really framing a lot of how at least I'm thinking about the self-sanctioning behavior is that these companies are going to take a cautious approach. With that said, so I think, even excluding the U.S. and Canada and U.K. Russian oil import bans, I think that's the main vector where we're going to see hits. I see that's predominantly going to be in the westward flows. So of, let's say, 5 million barrels a day of crude and condi exports from Russia, another 2 million barrels a day of products. We're probably talking somewhere in the ballpark. And the IEA actually released this morning estimates that showed somewhere in the ballpark of about 3 million barrels a day of capacity of initially exports lost from Russia, and then capacity lost over a longer period of time, because that's going to basically back up into inventories and cause shut-ins, which could cause longer-term capacity damage. I think the interesting thing here is that we've had this, in some ways, one of the largest real kind of supply shocks in history, particularly on a sustainable basis, at least kind of starting to flirt with the market. But at the same time, now we have all of this China COVID lockdown issue that seems to be extremely severe. The numbers are quite wild coming out of particularly Hong Kong. It's very, very low vaccination rates, particularly among some of the elderly populations. So this is obviously a huge problem. I think it's reasonable to assume that we're going to see massive lockdowns across not just Hong Kong, but broader areas through China. In the first round of lockdowns in 2020, that was about a 3.5 million barrel a day loss off the bat. That lasted about a month or two. It's hard to tell exactly because the official stats break around that January, February Chinese New Year period. But I think what's interesting is those are roughly the same numbers. So I think what we could see is a period whereby, we're going to see Russian losses. We haven't seen them yet. Most of the barrels that are still leaving Russian ports were purchased before the invasion. I think we're probably going to start to see that hit in the next week or two. Then it's going to be this question of how much we lose in China. Let's assume those cancel each other out momentarily. What I think that does is it blunts the initial impact, but I think potentially actually accentuates the back-end impact, which is not only is there less price signal for actors that should be price responsive like shale to kind of catch up and fill that gap, because, again, China will lock down hard, but it's not going to stay locked down. It will come back. That demand will come back. It's transitory, if we're still allowed to use the word. But on top of that, there's all of these questions of was there going to be cheating and pressure to, root around those kind of self-sanctioning or kind of pressure there from, let's say, India or China taking more purchases. If there's less demand and if prices are higher, I think there's less incentive for that cheating, and that just accentuates that, shut-in kind of backup phenomenon. So I think for me, there's a lot of moving parts, but it seems like we're entering a structurally kind of more bullish market on the supply side, both from the loss of potentially millions of barrels of Russian capacity and the fact that I think we'll talk later about how shale just isn't responding as all of our models assume they will. And I think that's going to be this big problem is, after I think we're going to get this brief period of kind of calm if the Chinese lockdowns are extreme, but then we're going to come back with a pretty strong snapback if history's any kind of parallel, and then we're going to be in big trouble by kind of mid to late summer.
Yeah, very interesting. I think what I'm hearing is that the risk is skewed to the upside, not to put words in Will Hare's mouth, but I think we kind of see it the same way. So Will, senior oil analyst at Bloomberg Intelligence, give us your take on the rough context and supply-demand balance looking out over the next 6 to 12 months as well.
Yeah, well, I think Rory covered it pretty well. The only thing that I would add is that I think taking a look at the spare capacity left in OPEC, which is roughly 4 to 5 million barrels a day, and when you frame that against the 3 million barrel a day initial impact from Russia, as the IEA put out this morning, along with the inventories that current inventory levels hitting 2014 lows, covering less than 60 days of demand, we are looking at a very little headroom in the market here, and yeah, pretty few near-term short cycle levers to help alleviate this pressure on the market. With U.S. shale, we can see that the Biden administration was suggesting or outright saying that it's their patriotic duty to increase volume, but keeping in mind that this subsector of the industry has been pilloried over the years for substandard returns, burning a lot of capital. It's a highly capital intensive part of the industry, and increasing and loud demands from investors to return cash rather than production. I think there's the outlook remains relatively tight over the near term here.
So very interesting. So what it sounds like to me is if we don't get some kind of workable peace agreement that gets Russian crude back onto the market in 2H at volumes prior to the crisis, we could be looking at a world where you got to clear the market with essentially demand destruction. Is that how you see it, Rory? And what is going on with U.S. shale? Why is it coming up so disappointing in terms of the supply response?
Yeah, I think you're totally right on the balancing point in the market in the second half. If we still have material Russian supply losses as demand destruction, the challenge there is that what price is demand destructive? I think We flirted with, 130s for a week. That didn't seem to have any real impact. It's still hard to say. It seems like most of the, high frequency US data seems to indicate that demand remains very strong. I think that at this stage, it seems, at least for my opinion, it seems more likely that if demand destruction were to occur, it would probably be because soaring energy costs sapped enough disposable income that it caused a broader macroeconomic slowdown, something veering on kind of recessionary territory, rather than there was a kind of a straight, comparison economic trade-off between, like the Biden administration is saying, if oil prices are high, go buy an electric car. And I think that's, that I think is there's two ways to think about demand destruction, right? There's this price elasticity of, if prices go higher, you consume less. And there's also this income elasticity, which is if prices go so high as to make, shock the economy that you lose your job, you will drive less. And I think at this stage, it seems more likely that it's that latter kind of income elasticity that will eventually take form if these prices do reach demand destructive territory. But to the question of shale, I think what's also really interesting here is once upon a time, when we used to build global supply demand models, it was always, you basically took everything non-OPEC and the residual was your kind of call on OPEC. Basically OPEC would fix it one way or the other. They'll pump more, they'll pump less, but that was your residual function. And that's how global supply demand models just kind of worked. Now with OPEC more or less caught up in OPEC plus, and that being a much stickier kind of, planned, scheduled supply release, now it seems like most of these models are effectively treating shale as a residual function. That what you saw with the EIA's latest short-term energy outlook was that they substantially downgraded Russian supply, not as much as the IEA report that I think has come out has had the benefit of 2 extra weeks of knowledge and development here. But what you saw was basically Russian supply curve, gets torqued down, and then the shale curve gets bumped up by another 400,000 barrels a day. So it's, the assumption is Russian supply will push prices higher, and higher prices will incentivize U.S. shale. Well, at the same time, you have people like, the CEO of Pioneer coming out and say it doesn't matter if it's $200 a barrel, we're not going to grow faster than 5%. And to Will's point, the capital destruction that we saw pre-COVID for that decade prior was only it was more than $300 billion for publicly listed, U.S. shale drillers, which is, just a staggering amount of money. And I think at this stage, it seems not unreasonable, from the position of equity holders to not believe that shale could grow again in a responsible manner. I don't know what really that looks like. They're all like, okay, well, we'll all agree to only grow, let's say 10% or 15%. No. After the gates are open, people are going to start growing again, and that behavior snaps back quickly. So I think it's not unreasonable for owners to say, just don't even flirt with it. Just sit back and enjoy these incredibly high returns and don't put any more capex in the ground. I think that's the challenge we're going to see. I think that's going to be most true with what I call the middle of the barbell. You have, on the high side, you have Exxon and Chevron, which are going to grow a bit faster in the Permian. On the low end, you have some of the privates that are going to, the PE financing is a bit more, generous. They're going to kind of burn through their inventory faster. It's that predominant big middle of the barbell, those American independent companies, that I think are going to be the stickier ones. And I think that's what we're seeing.
Very interesting. I've noted that in the news today, Prime Minister Boris Johnson is in UAE. I believe he's also headed to Saudi Arabia to hold meetings, I believe to ask for higher production volumes. I've seen lots of discussion about Venezuela and Iran. I think prior to the run-up, there was some sense that we could be close to an agreement to get more Iranian crude back onto the market. Will, what's your sense on kind of the realistic case for any kind of response from Iran or any of the other options outside of U.S. shale?
So nuclear Iran talks were supposedly close to the finish line recently, but have stalled on issues relating to impact of Russian sanctions. But it looks increasingly think possible for near term resolution here, and that would likely include somewhere around an extra 1 million barrels a day over the next 6 months or so. We think roughly half of that could be relatively quickly brought online, and the remaining more gradually. So obviously this is another potential easing factor in the tightness of the market. But at the upcoming OPEC meeting at the end of the month, this will be a fairly tense meeting, we think, because we've seen a lot of headlines come out from members. We saw the UAE call for more supply to be tapped down by their oil minister afterwards. We've just seen Libya suggest that more supply is needed, but obviously the spare capacity rests with Saudi Arabia and the UAE, and any increase from the existing 400,000 barrels a day month policy is almost certainly going to be landing on their shoulders, and so they'll be in the driver's seat, and particularly given the massive volatility we've seen back down to roughly $100 a barrel from over 130. They may be reticent to be increasing above their 400.
Rory, I'm going to nominate you as the sort of representative of Canada's oil patch. I know you're in Toronto, but what's Canada's role in all of this? And how quickly can Canada? Is there any flex there? Can they provide some additional barrels over the next 6 to 12 months as well?
I like to. Canada is a great, stable, friendly supplier of crude oil, but it is not fast. Unfortunately, it's probably one of the slowest responding sources of crude oil on the planet. It's definitionally the opposite of U.S. shale production. Now, I should say there are two Canadian oil industries. There's the oil sands, which is the larger kind of part that I think most people think of. There is a conventional side that does have kind of shale-like characteristics that could respond a bit faster, but we're talking relatively smaller number of barrels. I think what you'd need to see for a noticeable material increase in Canadian supply to the market would be higher prices, these $100 barrel prices for a year or two. I think that would really begin to kind of reinvigorate, what we're starting to hear again is, Canadian oil industry loves to hear talk of energy security because we're a big beneficiary of energy security discourse because, we're right there. We're kind of, Canada's the friendliest of countries. It's a great kind of juxtaposition versus the, seeming geopolitical quagmire of depending on Russian barrels. So that's a huge benefit for the decade after 2014. When energy security kind of fell out of favor, that's when you really saw kind of some of the broader support for pipelines like Keystone XL more or less fall by the wayside. But even if you did have a renewed environment where something like Keystone would pass or kind of could get built, big question. I think we said earlier, but we should probably change the name at the very least. But I think in that kind of situation, I think that you could probably eventually get to a stage where you're growing at 100,000 barrels a day annually as a steady state again, but it's going to need a lot more capex. The EIA's, STEO expects Canadian production to grow just shy of 300,000 barrels a day this year, but that's mostly because we've been flat for 2020 and 2021, down a little bit in 2020 actually. So that more or less had a more of a built-up pressure function that allows us to kind of get that growth, but then growth kind of slows again in 24. So I think what you'd need to see is a lot more investment to incentivize a faster pace of these brownfield expansions. Thankfully, we're going to have a decent amount of egress slack. So we've got Line 3 that's online now. We're going to have Trans Mountain expansion coming on soon, probably in 2023, early 2024. And we still have some slack in rail. So I don't think egress is going to be a major concern this time around, but I do think that we need more capex to get that growth.
Rory, you brought up energy security, and that's probably a really good segue to talk a little bit about the gas market. If you're sitting in North America, gas market looks stable, relatively calm and normal to some extent, but we've seen just an incredible rally in the benchmark price for European natural gas, and I think there's a growing sense that gas is not going to be a reliable bridge fuel when thinking about the energy transition. And so we're really starting to see a shift of the narrative. So Patricio Alvarez, our utilities and gas analyst for Europe, give us a sense of what the European gas market is potentially going to look like over the next 6 to 12 months.
Sure, Rob. So, quick answer is incredibly tight in the supply-demand balance. Even without the potential disruption from Russian gas flows, we were already seeing a tightening scenario just on the back of having storage levels way below their 5-year norm. And though they have recovered, thanks to an influx of LNG from the U.S. over the past month and a half or so, and milder weather, we were still seeing this tightening scenario that would have impeded the refilling of this storage before the beginning of next winter. So this led us to think that prices were still on track to being maybe 3 times or 4 times as much or higher than the previous 5-year average, which is, it's incredible. But that's sort of the position that we put ourselves in Europe, given our declining production and also our position as a market of last resort in terms of LNG. Given most of our we don't have a lot of long-term contracts signed, but it's rather Asian buyers that have these contracts in place, leaving little spare capacity for Europe to attract this way. In terms of the supply disruption risk, Russia is Europe's main supplier, accounting for anywhere from 30 to 40% of supply, depending how you cut it, including the UK, it's 30%, which is significant. And we, of course, in a scenario where we would see flows significantly suppressed, it's a bit scary to be honest. There's different scenarios ranging from different agencies that imply that we could replace this by 2/3 in 1 year. And this is via fuel switching in power generation, so reviving coal quite significantly in the short term. But we all know that will face hurdles from the environmental side. The other way beyond, well, there's not a lot of more piped gas supply that can come from North Africa or Norway, which is already close to being tapped out as it is. As I said, LNG spare capacity will remain constrained and also faces technical constraints in terms of the way that Europe imports that gas. Most of the LNG terminals are in the UK and in southern Europe, in Spain and in Portugal, and the pipeline infrastructure is just not geared to transport the gas inland. So even if we did sustain this pace of LNG imports, it's technically impossible to replace that gas. On that front, we think any scenario would likely have a significant measure of demand destruction, particularly in this industrial sector and perhaps in the power generation sector as well.
Yeah, very interesting, Patricio. It's sort of stunning. We have this incredible conundrum, incredibly tight oil market over the next 6 to 12 months, an incredibly tight European natural gas market. So I want to go over to you again, Will. How are the European oil majors positioning around this? They obviously have exposure to both oil and the gas side of the equation, and increasingly they're putting more capex towards clean energy. So what's their take on all this, and how are they going to adjust their strategy over the near term here?
So near term, we are seeing absolutely zero change in these companies' strategies. We've actually heard a couple of comments from BP CEO Bernard Looney that they anticipate no change at all to their long-term strategies. These are based around the energy transition. These are large companies that are not really amenable to making, short-term adjustments in capital allocation based on what's happening to the spot price or the next month's forward. So yeah, we think that this transition capex priority of roughly 15 to 20% this year will be maintained or even accelerated based on a massive cash flow catalyst here from these elevated prices that we're seeing. I think it's also worth noting that given the role that U.S. shale is sort of being asked or almost expected to play here in filling this supply gap, that the European majors really have a dearth of exposure here to short cycle production. We've actually seen the U.S. shale patch been one of the primary candidates for divestment from European majors. Only BP remains as having a decent exposure to U.S. shale through its BPX division. We saw Shell sell their Permian portfolio to Conoco in 2021. We've seen Equinor sell their Bakken to a private company, and there's nearly all of the exposure that's being held outside of BPX is heavily gas weighted. So the European majors just do not have the right portfolio exposure to be ramping up on the oil side, and I think it's worth highlighting that some of these renewable power capacity targets that the Europeans have highlighted are ambitious, are really ambitious. They are utility level scale renewable power that these companies are developing. They're going to be some of the largest acquirers of renewable power in the next few years. And we think the additional cash flow that's going to be coming through as a result of the current and prevailing elevated commodity backdrop can and will be deployed into the energy transition strategies, which of course are centered around renewable power.
Very interesting. Will, Rory, I want to get your take on this idea that Will was just discussing, and I wonder what the sense is in North America. Have we sleptwalk into this crisis? Has the focus on renewables for the European oil majors been a distraction? Was the industry already under-investing well before we hit these kind of important geopolitical type events? So over to you.
Yeah, I mean, I definitely think that, sleepwalking feels pejorative, but we definitely weren't investing as much as we needed to heading into this. But I don't think that's, I think a lot of people kind of point to, this ESG constraint or this kind of divestment constraint. I think there's a little bit there. I think, there's probably a little bit of that play in getting rid of some of the shale acreage, although maybe it's just that there's actually willing buyers there. It's definitely a consideration when, the only place that the European majors like to pull out faster than the shale patch is the oil sands. So I think that's, something that's definitely playing there. But I think more broadly, it's just the fact that there was a decade of really, really terrible returns. Because we're not just seeing it on the oil and gas side. We're seeing it on the metal side. We're seeing it across the entire commodity space. So I think that's the biggest driver. But I think that, the question is, where do we go from here? And do companies start to reinvest? And I think it was not as strange to me that there was low investment. I think what's stranger now is that we're not seeing a material commitment to pick up that investment going forward. Normally, we like to think, if we look at a history of prices versus costs, I think a lot of people typically say that, prices don't fall below cost. That's your lower constraint. But I actually typically think it's the other way around, that, costs chase prices up and down. That as the prices crash, the industry turns down, you basically get slack in the supply chains, you get a pressure to reduce costs, et cetera, et cetera. But what we're seeing right now, normally with a price spike like this, you'd see every company clamoring to get back into this space, bidding up those contract prices, bidding up the entire supply chain. One, the supply chain is already really, really tight, and there doesn't seem to be a massive kind of impetus to kind of jump back into the CapEx game, at least not in a real way. To the question about, are renewables a distraction? I think that as it comes to the European majors in particular, I think there are some small examples where there is a true kind of earned expertise in an area. I think of something like Equinor and ultra deep offshore that lends itself very nicely to installing, ultra deep offshore wind farms or maintaining and supplying those. I don't understand, for me at least, why, just because these companies are energy majors, they need to pivot to the next big energy thing. It seems, to me at least, like this is something that's better done by people with strong backgrounds and expertise in grid markets, in renewables, et cetera. I don't know if necessarily that operating in far-flung, politically risky, and geologically complex industries is a natural comparative advantage. So personally, I would love to see that oil companies across the board stick to what they're good at doing, which is producing oil, and then other companies kind of come in and use the ample kind of capital that's available for these types of expansions to expand that area. And I worry that if we're just trying to crowd the energy majors into that same pie, no one is tending to that kind of traditional energy system. I think that's what we've gotten into trouble here. It's no doubt that we're kind of going down this, inevitable energy transition towards net zero. The timeline is debatable, but we're heading that direction. But I think that often that just means that people just think we don't need to treat and deal with that old stuff. And I think that old stuff is really, really important, probably actually most important at a time of transition, because that's when people are neglecting it. I think that's my worry right now, is that the fact that the European majors aren't even thinking about increasing production at the same time that the U.S. shale producers aren't thinking about increasing production, and Canada really can't. We're running out of places that can increase production, which it makes me worry that we're just going to end up down a kind of a supply side driven energy transition, which is kind of least optimal for everyone involved.
Patricio, you cover some of the names on the other end of the idea that Rory was just talking about. So, Iberdrola, Ørsted, these kind of companies, what does their future look like over the next couple of years? And are they being crowded out by some of the investment that the European oil majors are making?
So Rory made an excellent point. So companies with the size and scale of Iberdrola or now, they have a global footprint and really well-established supply chains, which actually gives them sort of this competitive advantage versus new entrants. So they're actually, it would be the opposite. Like they would probably crowd out the smaller players. Being that said, most of the offshore or onshore developers will probably sell their stakes to the VPs and Equinor. Is not like they're going to develop them themselves. But large utility scale developers have a clear advantage so far. And as I see it, there's concerns about inflation and supply chain disruptions. But as I said, most of the companies I cover, at least the ones that are anywhere above maybe 20 gigawatts in capacity, they're pretty well hedged. They've already procured most of their equipment in advance, and we haven't seen any disruption to their growth plans. But as Will said earlier, of course, you have companies like Total that are going to step on the toes of utilities. But I don't see any immediate risk to their growth profiles, at least not in the midterm.
Thank you, Patricio. I think we're going to have to stop it there. I know we could talk because this stuff is so exciting and we're all sort of in the weeds on it. We could keep going for quite a bit more time here, but I want to be respectful of everyone's time. Rory, this has been excellent to have another view on the market and sort of to swap notes and share with our customers kind of a different perspective. So thank you so much for joining. This was really fun. For anyone who doesn't know Rory, check him out. He's very active on Twitter, and he's quite generous with sharing his views on all the kind of stuff we discussed here today. So I hope everyone has a great remainder of their week. And as always, you can find all of our research on BI Go on the terminal, and you're welcome to shoot us a message or an IB if you have any follow-up questions or comments. Take care, everyone.
Thanks, everyone.